Our strategies have tended to be overweight securitized, not because we said one day we're just going to buy securitized. It's because a very long process of looking at the markets and finding opportunities and inefficiencies to build better portfolios.
And my focus is on asset-backed securities. So these are bonds backed by collateral such as credit card receivables, auto loans, and the like. I think what differentiates most of the fixed income markets from asset-backed securities or structured credit in general is that we have assets and cash flows that are pledged to our bonds. We need to really get a good sense of their prospective performance. So we start off with looking at the underlying collateral, right? So whether it's comprised of loans, leases, so we can say in the last 10 years, this pool has traditionally had losses of 10% a year. Delinquencies have typically been 5%, recoveries 50%. But I think what's really cool about ABS is you're dealing with thousands and thousands of borrowers in each pool. It's more about knowing what position you hold and at what levels of macro deterioration are those positions robust.
The sector I cover is CMBS, or people call it commercial mortgage-backed security. I think it's very logical and it's very transparent. For housing, for example, there's option to rent or there's option to own. So I always compare, like, is it cheaper to rent? What kind of lifestyle people would get as a renter versus the ownership? And if you wanted to live in the suburbs or if people wanted to live in the cities. So we would value the sponsor, which is the owner as well. How much do they like the asset? Do they have the capital to make it through the downtime? And do we think the asset itself is generating enough competitive advantage? I think from us, it's like we want to take a forward-looking, like something that can go through different cycles, and it's going to survive as current function long-term.
Yeah, when we think about securitized deals, these deals will have losses. Almost all of these deals have some form of losses. So the bonds have all these sort of building credit enhancement that you really don't find in like a corporate bond structure. So it's kind of unique to the securitized market.
One of the things that we like about the securitized market is the credit enhancements. So the things that protect investors that are put in place that you don't get with credit. And there are more opportunities for same relative risk, or even, I would say, higher quality than what you're getting in the rest of the market.